I mean, I think markets are already volatile right now, but much more volatility to markets because you've lost that trust in central banks doing what they're going to say. Jack, you're the macro man. What do you think?
Yes, I think a guy by the name of Joseph Wang, who's done well by me and my audience. He used to work at the Fed. He, I believe, is of the belief, and so I'm sort of just taking from him that it's very unlikely that the Federal Reserve will do an intra-meeting rate hike, at least in the near future. I know Noel Smith. I've interviewed Noel Smith. He's a volatility legend. We would love to get back in touch with him, but that's at least what Joseph says. Now, on the topic of moving from a 50 to a 75, I think that's in the arsenal. But I think there was an article from Nick Timmeros of the Wall Street Journal, who's kind of the mouthpiece. He's been on my podcast, Forward Guidance. And if he writes an article saying the Federal Reserve is still preparing to do 50 basis points, he probably talked to someone senior from the Fed who had some assurances that of course they can be broken, but the Federal Reserve does not want to shock anyone. The Federal Reserve has been looking at the sell-off in the S&P 500, and they're like, yes, 40 basis points a day, let's do it. They want it down, but they don't want they want 20% down with the VIX at 25. They don't want 15% with the VIX at 50. Yeah,
I think the Fed wants to shock people during periods of market volatility and shock them with, I don't want to say good news, but right, like bigger unexpected rate cuts and discussions of quantitative easing to abate fear. I think when you shock the other direction, faster quantitative tightening or a more rapid increase in rates, that injects more fear into the market. And I'm not sure the Fed wants to do that because, again, credibility is something that you can lose instantaneously. It takes a long time to build, and you can lose it instantly. And once they lose it, that tool is gone from their arsenal. So, again, guidance is hugely important to them. I'm not sure, today's print, which was mildly hotter than expected, will be enough for them to want to forego their credibility.
Yeah, so that, what do you say?
Bigly. He was talking hugely, bigly. Sorry, go ahead, Jack.
Yeah, so there are the two big tools are the price of money and then the quantity of money. Both the actual doing the lever itself as well as forward guidance, I'd both say that's the short-term price of money, like the overnight, the Fed funds rate, as well. Which, by the way, no one even uses that anymore. It's like only a few, like Fannie Mae, like everyone uses the reverse repo facility. So it's that as well as how many bank reserves are in the system. So that's the size of the Fed's balance sheets. This month, we officially started QT, although I don't think that we're going to have our first roll-off until June 15th. And ultimately, over the course of 3 months, we want to get on the Fed, we want to get 60 billions of treasuries and 35 of mortgage-backed securities, so 95 billion in total off of the Fed's balance sheets. And I was just talking to Michael Howell and Joseph Wang. That interview airs on Monday, and they think that the QE, or now QT, is much more important. It's the capacity of the balance sheet much more than the price of money. Because I don't really know what I'm talking about here, but no one uses the Fed funds rate. It's kind of a sham. Like,
Jack, I like to think we're having an impact on you saying, I don't really know what I'm talking about here. Because that is this entire podcast. We have no idea what we're talking about.
My favorite two things you guys said is what the Fed wants. And I was like, I'm just impressed that you guys know what the Fed wants. And then, Jack, you referenced somebody else saying my favorite is like, I have an insider at the Fed or an insider in Washington. I'm like, present them.
I want to clarify. I said, I don't think the Fed wants. I have no idea what the Fed does or does want. I can just speculate what they don't want.
The question I have, and maybe Jack, you were able to pull on the numbers earlier and actually look at it, is like how much of it was energies? Because usually, that's what I think.
Energies? What do you mean?
On CPI, this latest print, how much of it? How much was the basket? How much was it the increase in price in energy sector? Because that's the one I always look at that are more concerned with than anything. Is like everybody's talking about inflation, and basket of CPI. And one of my bugbears is I can't stand that everybody hates on CPI. It says it's a terrible basket, and then they quote CPI for inflation or inflation break-evens. Like, it doesn't make sense. So, but what's always interesting is that the predominance of energies within that basket. And so when everybody's worried about inflation, I mean, are we more worried about the historical relationship with oil prices being so high it's really hard for markets to rebound and not grind lower if you have increasing energy prices.
Yes, I mean, I don't really have any insight about why that is. I mean, like people just put up a chart of, they say whenever oil price goes up, you always have a recession following it. It's like, well, I don't think the spike in oil was why we had a great financial crisis. I think it had something to do with a certain thing called like a credit default swap, securitized credit, banks performing, being extremely, dumb, I should say. But yeah, I mean, what did core come in? Core came in lower. It's energy is always responsible for so much of the month-over-month volatility, because from in April, first was reported, April's CPI report, price natural gas and oil went down slightly, so you had a headline that was like slightly lower than core, and this time you had headlines. So yeah, it's just I don't know, Jason.
You see what happens when you're on the spot here on a live show? You start rambling, then you get in your head, and you start going, I don't know what I'm talking about. Why am I still talking? I love it.
Joe Weisenthal talking about the rate of change, Jason. Joe Weisenthal had a great tweet today that was like, he was plotting the monthly CPI print numbers, and this month was slightly less than last month, and he was like, I thought this was good, and it was. Yeah,
well, that's why I was trying to find real quick before we got on. I wanted to see that the monthly and are we still in decline, or did this one bump it up a little bit? But like once again, like you and I was talking, is that a spurious like anecdote, like versus like the monthly rate of change over a longer time horizon? And the other one, and this is just totally tangential, but I always think it's slightly interesting, is like Mike Green and I used to always talk about inflation break evens were an interesting way to have like a proxy bet on oil or energies. But diving into that, we didn't have a time to do like a really in-depth study. But oil prices have less impact on inflation break-evens than they typically did in the past. So I'm not sure what the correlation or causation necessarily is there. But it was interesting that whether it's TIPS, CPI, or using inflation break-evens, it's maybe not having as an impactful way as it used to historically in the 70s and 80s.
Can we see this? No. Okay. So let's see. No, you guys can't see. Oh, here we go. Nope. Here we go. Okay. Yes,
there we go.
Core CPI has fallen for 2 straight months. It was now at 6%. It did fall a year ago for 2 straight months as well. So I think we're really close to peak inflation for headline and core. Everyone says that. I agree with that, but the problem is everyone's been saying that for a year and they've been wrong. But
so why? Let me ask you this, because Jason, I can already tell you what Jason thinks. Jason's going to say, "I have no idea if we've reached peak."
Yeah.
Why?
Well, you're right in my head. Yeah. Why do you think we reached peak?
I know you, because I'm doing the same thing. I'm like, I've got zero clue here, right? Because you could have continued just as easily as you could say we've reached peak. I could see a scenario where you get stronger shocks coming out of Europe due to greater war pressures, right? I mean, like there's all sorts of scenarios I can think of where it could go the other direction that are very path dependent, but they can move from a possibility to a probability. So like, I would love to know from your perspective, what makes you think we've hit sort of near or at peak prints?
Jason or me?
No, you. You're the one.
Jason has no view.
Trees can't grow to the sky, Corey.
You ever heard of hyperinflation, Jack?
Yeah, no. I think there comes a point at which demand is destroyed. To be clear, I'm not, and I've been fading the inflation, the transitory narrative for like almost a year now. But I think even I am saying like there comes a point when it's going to be, we're going to reach peak inflation, and Joe is right that we probably have reached peak core inflation now. The question is, how high can the price of oil go? I would say, Corey, that the way that the market is positioned, let's say the short end of the yield curve and the long end, is pricing in, like the forward inflation curve, the break-even curve, is pricing in that inflation that we already have reached peak inflation. So if you're right, and it's sort of a bell distribution from the 8.5% number we're there, I would probably not be buying like short-term bonds or 5-year, 10-year, anything, just because if it can go to 12%, I mean, my God, there is so much more pain to come. But I think we're close. I didn't say we're there. I said we're close.
You my favorite part of that is we're in financial markets, so you can bet on it, right? And the other thing is like when Corey's asking what makes you think that, and like no shade, it's like this is how we all think, is like what makes you think that we're past like peak inflation? It's a lifetime of subjective experience and a guess and a finger in the air that this is your expectation based on the way you view markets. That's really the reason, right? We can use all these fancy terminologies and start pulling numbers out of our ass to support our claims, but it's really just a subjective guess, right?
It's also interesting, Jack, to think about, right, market implied views on this stuff to say what different swap curves are saying or break-even curves are saying. Because I think it's always worth acknowledging that markets, right, can be priced in a way that people are hedging risks they have. And you're not getting a real world probability curve. You're getting what's called a risk neutral probability curve. So when you try to back out what the market is necessarily saying, you have to take into account that there is risk aversion, in theory, baked into those prices. And so it may not be what the real world probability view of that event is.
Yes.
Right. It's sort of a simple way of saying is why are puts so much more expensive? It's not because it has a higher probability. It's that people want the protection from that, state of the world when it happens, that's more valuable than the upside to them. And so that doesn't mean that the market thinks it's more probable or more likely. It just values protection in that state of the world more. And that's not, you can't always back out probability distributions from markets and say that's the market's view of what's going to happen.
100%. I'd go even further and say if the 2-year forward rate is at 3%, the market thinks the Fed is blah, blah, blah. It's like, well, no, maybe people were just hedging out. They were extremely long 5-year rates, so they were just hedging something.
Yeah, exactly.
Yeah.
Do you have any other questions or?
Hit me with a zinger. One last one, Jack.
One more zinger.
I'm coming in. I don't even know what the question is, but I'm coming in with a strong opinion.
Oh, shoot.
Okay.
Jason, you want to go?
Yeah, we got 90 seconds on the clock. Tell us about return stacking. No, I just actually I do have something.
How about I tell you about rebalance premium? Your Lord.
That's what I was going to bring up. No, yeah. So rebalance premium. You're right. You're right. You like mine. What would I say? The rebalancing luck premium or whatever. Like trying to use your own words. Yes. So Corey put out a tweet this week attacking rebalancing premium.
It was not attacking.
Yeah, but you were being very rational, and once again, these are our typical arguments about semantics, and you were showing that there is no rebalancing premium. So I'll give you the floor, and then.
So, God, do I really? I have 90 seconds for this.
No, right, Jeff, take your time. Take your time.
Yeah, well, people argue that there is a concept called rebalancing premium, and I would recommend everyone go check out a blog called Breaking the Market. Matt, who writes it, is very thoughtful, is a very strong proponent of the rebalance premium. He goes so far as to say everything in markets is a rebalance premium. I think he's a very smart guy, very thought-provoking stuff. I happen to disagree. When you look at what rebalancing does, there is no mechanical benefit that occurs at the point of rebalance. What rebalancing should do in theory is move you to a more optimal portfolio. And it's the construction of that portfolio that ends up harvesting some sort of premium or higher geometric growth rate because you've maximized the embedded diversification in the portfolio. But the actual act of rebalancing itself can only generate an excess return in the portfolio if you're rebalancing over a horizon in which the exposures you're rebalancing on are mean reverting. And that's not always the case. And so what I was trying to articulate, probably poorly because it's Twitter, is that I don't think there is a rebalancing premium. The same way, and like the way I would liken this is people talk about roll yield, right? And rolling down the curve. The act of actually selling the front month future to say, and buy the next future is not what captures roll yield. Like all you're doing is keeping the same amount of money exposure you had. You're just changing contracts. You're just changing the numeraire of what you own. And then setting yourself up to capture the premium as that further out contract rolls towards spot. that rebalance enables you to capture the premium, but the rebalance itself doesn't capture the premium. If you want to buy value stocks, yes, you have to constantly rebalance your portfolio, but the premium in buying value stocks doesn't come from rebalancing the portfolio. It comes from the fact that people are willing to sell you stocks below their fair value because there's either a behavioral bias or a risk aversion. Matt disagrees with everything I just said. I would highly encourage you to go read his blog. It's really thought-provoking stuff. He and I respectfully disagree with one another, and because I have a loud mouth, I went off on Twitter and got lots of comments.
Well, even better, we're talking about it now without Matt being on here to defend himself. So actually, I will, in a way, or I'll go in between, because you and I have talked about this so much privately. And by the way, and shout out to Matt Hollerback, and everybody go check out Breaking the Market. But better, check out this thread between him and Corey, and it's very thought provoking, gives you a lot to think about. But I really do believe at the end of the day, we're talking about semantics, and I believe if Matt was on here, he would agree with you, because I'm going to break it down really simply into just two parts. One is, when you're talking about premium, you are talking about a very specific definition of like an alpha, right? For lack of a better term. Like there is an actual sustainable premium from doing something that is above and beyond the efficient market. And therefore it's a premium, right? And so that's your issue, is like, it is not a premium or premia or whatever we want to call it. And I completely agree with you on the actual definitional case. It is not a premium. And I think Matt would agree. But we sometimes on Twitter, it's hard. It's not many characters. And then we don't really create definitions for our priors. And so we maybe use language a little bit more loosely than you would prefer. So I that's the one I think that where it's getting hung up. And then the second part where I think Matt would definitely agree on, and where you and I agreed on, or maybe you don't anymore, but like this is what I'm always talking about, is like, if you're reducing the delta between the arithmetic and the geometric return, that is a positive thing. Now, calling it premium is where you take umbrage with it. So that's what we're really talking about.
Yeah.
Right?
So I do take umbrage with calling it a premium, because to not do that would be irrational. But I would call that diversification benefit, because the way you do that is through diversification. Matt would say, I don't want to put words in his mouth, but sort of what my interpretation of what he's saying on Twitter and from reading his blog is, no, it's actually rebalancing that capture that you have to rebalance. And in fact, rebalancing more frequently allows you to capture a higher geometric growth rate. And so therefore the active rebalancing is what does it. I would agree that you have to rebalance to maximize that. But it's not the rebalancing that actually triggers where you're capturing it from. It's from using the rebalance to go back to a more diversified portfolio. So sort of the last thing I said in my thread, and I added it on later, was saying, look, for me, a lot of times when I think about markets, I have to break out to a different space and reframe the conversation. So the way I sort of thought of this is, I said, let's say we have a 60-40 portfolio, and we know 60-40, I'm not saying it does, but in this theoretical case, it maximizes the compound growth rate. And for whatever reason, we drift away. Well, one answer is to rebalance back. The other answer would be to engage in a total return swap with a counterparty. So let's say I owned more stocks than I wanted. I could say, I want to buy the return of bonds and sell you the return of stocks. And to claim that there is a rebalancing premium, to me, is to claim that when you engage in that total return swap, you expect to be paid a perpetual fee for engaging in that swap.
Yeah. And you're always like, who's on the other side paying that fee? You're right.
And who's paying you that fee? And if you do believe that there is someone on the other side, that's possible, right? Because you could argue, as people have, there might actually be, over certain horizons, a mean reversionary trade. Or you could argue that in certain conditions, by rebalancing, you are becoming a liquidity provider. And so there may be an argument that you should get paid for that perpetual swap. But to me, like, a lot of the tools I try to use when thinking about markets and thinking about portfolio construction is reframing the concept into something equivalent, but totally different. And if it doesn't hold in the totally different scenario, then it can't hold for the former case. And so for me, that's sort of how I think about things. So maybe the lesson here is not, hey, Corey's right, Matt's wrong. Corey could be 100% wrong here, and Matt could be 100% right. for me, I think the interesting takeaway is rethinking about what is rebalancing, putting it in a different framework of long short portfolios or total return swaps, and trying to reframe the problem to think about it through a different lens and maybe come up with an answer a different way.
Yeah, and just so and that's what's great about that thread is you guys start discussing the nuances, and that's the point. And so for those that don't know, the all three of us in our tri-umbrella, shout out to Menahem for that word, is we're
getting someone, by the way, you saying triumvirate and me saying numeraire.
Yeah.
I think we got to change our vocabulary.
Yeah. Menahem came up with tri-umbrella. I like that. But just so people know, the three of us all agree on broad, proper diversification and rebalancing and trying to improve your CAGR. Like, there's no disagreement there.
Yeah, like most things, we're just fighting about the stupid nuances. Someone actually on Twitter said, only on FinTwit can you get people absolutely agreeing and then violently disagreeing about semantics.
Exactly.
I was like, that's about right. So, Jax, that's all I've got. That's my rant of the week.
That's good. Yeah, I'm glad you kept it to 90 seconds.
Yeah. Can I say, by the way, I was actually really impressed. I was either not on Twitter this week or people were good. I didn't see any chart crimes. Which
maybe you're becoming a chart criminal, Corey.
Oh, that could be it.
No, that's not it. That's good. Well, I wanted to say, so I think I today observed the first bona fide short squeeze that I've seen in a year. I'm sure there have been others over the past year, but the first I've seen in a year since like GameStop and AMC, over a year. And I went on Wall Street Bets to see if people were talking about it, and they were all talking about macro. They were all talking about inflation and the Fed.
What was the short squeeze?
Yeah. Redbox. And like AMC, it is a movie company. And there is a screenshot I saw of someone saying, like, is Redbox still around? And the Redbox official account was like, not really.
You gotta love the official accounts when they have humor, like Wendy's.
I think it's a warrants thing. It's like the warrants, when they go public, they when the SEC, they file with the SEC, like that the warrants can be actually traded, like either goes up a ton or goes down a ton. Also, do you guys just know how poorly SPACs have been performing? It's crazy. Like, do you know that the like 270 D-SPACs that are in this index? Do you want to know what the average return is?
Negative 80%.
Yeah, I was gonna say negative 80.
Negative 60%.
Yeah, close.
Yeah,
it's not great.
It's not great.
Guys, I got nothing else. I'm running out of energy on this Friday. Want to thank everybody in the comments for joining us live. That's Corey Hoffstein. That's Jack Farley.
You did it wrong.
I did it right.
Wow. That's Jason. That's Jack.
I did it right. I did Corey, Jack. No? Is it not looking interestingly on yours?
Not. Maybe you're according to what you saw, but we're.
It's like mirrors.
Whatever.
I'm just so confused.
Whatever.
I'm just. All right. Subscribe, like all the good stuff on Blockworks. We'll be back next Friday at 3 Eastern. Follow us all on Twitter, especially Jack. Who cares about Corey and I?
No, not true. Follow Corey and me. Who cares about Jason? Exactly. Well, Jason, you're Jason Macro. Okay. But next week we'll be talking 100% about the Fed. Corey and Jason will have been written treatises just about what is going on in Jay Powell's mind and what's going to happen. All right. Thanks so much.